welcome. Drew Blazek here in Logos and Markets. In this video, this is the second video we're going to do on our model when we computed WACC. Now we're going to show the uses of WACC, and we're going to see the impact of WACC if we change the capital structure in the third video. So let's get right to it. In the first video, what we did, we calculated WACC, which I brought over here. Oh, let me kind of scroll over. So we got the WACC right there, 12.29% based on this company and what this company has. It has preferred stock, has common stock, and it has debt. So in this video, we're going to calculate the valuation. How do you evaluate this company? We have a stock price of $26 a share. And what we want to know is, well, what do we evaluate this company today through a method? Is it worth buying the company, right? That's what the market rate is. Now we're going to make an estimate based on our valuation. So we're going to do the enterprise value first. And then after the enterprise value, we can find out the equity value. And the equity value is what shareholders. So just kind of give you a quick little insight on it, is that the enterprise value has to do with equity plus debt. So it shows a total valuation of the company. But the shareholders want to know the equity part. How much important is the equity portion? So that's what we're going to find out the true value of the stock price. And then we can compare it to the actual market price. So let's do the enterprise first. We want to know what is the operating income. So that's what we want to bring in. So real quick thing about financial modeling. Now, typically, if you see a blue font, that's going to be an input. If you see a black font, that's going to be calculated. If you see red, that's going to be something I'm bringing in. Maybe I didn't do it earlier, but I do have that method going on, that process going on for the valuation method. So that's what the red means. So what we're going to do is, where is EBIT found? Let's go to the financial model. And we're right at the income statement. So we want the first projected year of EBIT, and we're going to bring that in. And I'm going to hold down Shift, drag it over, and Control R. Next, what we want to know is, what is the net operating profit after taxes? We're not including interest at this point to find the enterprise value. And so what we want to do is find out NOPAT. So I'm going to take the EBIT, and I'm going to multiply it times 1 minus, and you see the tax rate is right over to the side, M10. I'm going to hit Function F4. I'm going to freeze that, close it up, and then that's going to be our NOPAT, calculated field. Hit Control R. Next we want to do is, we have to bring in some values here. So I have to bring in depreciation because we want to bring in the, on the income statement, when we brought in EBIT, well, we subtracted out depreciation. Depreciation was never a direct outlay of cash. We only did depreciation to have a lower tax burden. So we have to add back in depreciation because we have to find out the free cash flow. That's what we're trying to find out. So what we're going to do is, in depreciation, there's a bunch of values where you could pull it from. I could pull it from the income statement, depreciation. I could pull it from the cash flow statement, depreciation. They're both positive there. And then I could pull it in from the depreciation schedule. So we have it right there. So I'm just going to bring it from the depreciation schedule. You could link it in any way you want. Next, we want to know is, what is the change of net working capital? Again, we want to know how much cash we actually have. And the income statement says, you know what, you made $1 million, but last year we had about 30% purchased on credit. Well, this year we have 90% purchased on credit. That means, not in our example, but I'm giving you a little example why we have to find out the change in net working capital, is because if they purchased on credit, we don't have that cash yet. They got to pay it to us later on. Therefore, if the accounts receivable went up or cash went down, inventories went up or cash went down, accounts payable, if a liability goes up, our cash goes down. Liabilities goes up or cash goes up. Liabilities goes down or cash goes down. So always remember that a liability is a direct relationship. It does the same thing with cash. And an asset does the opposite. So easy way to think about it: if you increase debt, that means you have more cash, right? If I took $1 million loan today, I have $1 million cash in my account. I have to pay it back. It's a liability. I have more cash. However, my debt goes down. I'm paying off my debt. Well, my cash is going down because I have to use cash to pay off my debt. And another good one to kind of think about is inventory. If your inventory goes up, you had to use cash to buy the inventory. We want to find out what's going on with our inventory. If we sell through our inventory, we're making tons of money. Our inventory is going down, cash goes up. So what we're going to do, where is this found? The network and capital. So there's something called the working capital schedule, which is right here. And so we want that first projected year, which is negative 7.2. And I want to show you what we did in this one. And this might seem a little different than what you're used to. Was what we found at net working capital, I summed up all the assets and I subtracted out the liabilities. And that gave us the net working capital. To find the change in working capital, we did the cash impact. I did the previous year minus the current year. Therefore, that means this is the direct sign of how cash is happening. So this change in net working capital, if you look it up in a textbook, it may say negative. But in this example, we did the example, we want to know how is cash changing. So it's declining by 7.2. So that is the correct sign of it. And then last, we want to know what is the capital expenditure. We want to know, did we use our money? Because since we added back depreciation, which is the depreciation of CapEx, well, do we use cash to actually buy CapEx? So there's a bunch of locations we could find that too. We'll kind of go through that. You could go to the assumptions page. That's where it's located. But you want to think about where is it found here? The cash flow statement's found. So what I'm going to do, you can find it in the depreciation schedule. I think the easiest is I'm just going to go to the assumptions page and I'm going to select that and pull it over. All right, I made a mistake. This is a good thing to know about Excel. I actually hit R, and if I go down, I hit Control Z, it backtracks, and then I can hit Control R, and we just dragged it in. So we got our values. Next, what I want to find out, what is our unlevered cash flow? Unlevered free cash flow. So how much cash do we really have? So what we're going to do is we want to think about what sign, what to subtract, what to add. So we're going to take Notepad, and I want to add in depreciation. Since depreciation is a positive on here, I'm going to add it. If it was a negative, if you brought it in as a negative, you could have, depending how you labeled it in different areas. Then you want to subtract it to make sure it's a positive because you're going to add it back in. Next is the change in net working capital. Remember, that was how cash is actually working. So that is just going to be an add. If you go to a textbook, it'll say subtract. It's just because of how we calculated is different. And then capital expenditures, I have it as a positive in that value, but we want to subtract it. All right, so those are the free cash flow. Next, what we want to do is find out the present value of the next 5 years, right? I'm going to discount next year, year 2, year 3, up to year 5 to 2030. If you notice, I put a 1, 2, 3, 4 to make it a lot easier. So what we want to do, we have the WACC. So we're going to do this function is it's just a present value function. We want to put everything in today. So I'm going to take that cash flow and I'm going to divide it by, and then we're going to do 1 plus the interest rate, which is WACC. I'm going to hit function F4. I want to freeze that, put dollar signs on it. So when I drag it across, I want this to drag. I want the year to drag. So I'm going to go to the power of that. The only thing I do not want to drag over is the WACC. So once we do that, I'm going to hit Control R. That's the present value of the next 5 years. Well, then you're going to ask, well, how is that a good valuation of the company? It's only 5 years. Now, if they go out of business in that year, so the 6th year they're out of business, that means yes, that would be the valuation today. But we made the assumption it has a long-term growth. It has a long-term growth of 2.5% forever. So after this 5th year, and you can see it's going up, right? It's kind of going up a lot, and then went down. But we're making the assumption it's going to have a 2.5 growth forever. And what we want to do is in year 5, we're going to do a perpetuity equation. It's called the terminal value. I want to know all future cash flows forever if it's constant, and it is at a 2.5% growth. I want to know what it is forever. And I want to do the perpetuity equation and find out, well, if you purchased it in year 5, what is it worth in year 5, right? If you bought it in year 5, after all these cash flows happen, and it's going to grow at 2.5% forever, that's what we're trying to find out. So I'm going to go equals. So I'm going to bracket it. And if you know the perpetuity equation, you need the cash flow for the next year. If I'm going to find the 5th year, I need to know the cash flow for the 6th year. So what I'm going to do is I'm going to select that cash flow, and I'm going to grow that at the constant rate of 2.5. So I'm going to grow that, and I'm going to multiply it times 1 plus, if you remember on this side, we put that growth rate. I'm going to go back over to show what it looks like. I'm going to hit 2 brackets now. So what is this? This is the projected cash flow in year 6 if it grows at 2.5%. That's what I want. And then I'm going to divide it by the perpetuity equation is the required return, which is WACC, minus the constant growth of 2.5. I'm going to close it up. And what that is, again, that's the perpetuity. That is what all cash flows in year 5 for eternity is worth in year 5. So since this cash flow is all the next cash flows forever, we have to know what is this cash flow worth in the present. So we have to know the present value of the terminal value. So we're going to go equals. So I'm going to discount it, the present value. And that's going to be 1 plus. I'm going to discount it at WACC. And then I'm going to do it to the power of 5 because of that perpetuity. So this is a great time to kind of talk about anytime you do a terminal value, there's 2 cash flows in that last projected year. There is the cash flow that's unique, which is that 54.1, and then the perpetuity. What I could have done was add the 50.1 plus the 566.8 and added that together and found the present value of that. So just want to show that. Okay, so that's the present value. Next, what we want to find out is I'm going to go to the enterprise value of the discounted cash flow. So we discounted all of these, and then we discounted the last, the terminal, the perpetuity. So all I'm going to do is add those up. So it's going to be the sum of all the present. So in other words, it's the net present value. We're finding the present value of all future cash flows. So we have those projected unique years. I'm going to hit comma, and then I'm going to do the present value of the perpetuity. Make sure you hit comma. If you hit plus, it does something weird. So this company, that's what it is worth. The enterprise value is $504 million. And then next what we want to do is let's find out what it is per share. So we're going to take that value and I'm going to divide it by shares outstanding. I forgot. That's 504 million. So it's important to do this. Is I have to multiply that times 1,000 to get the actual value of per share, right? So if you want, I just don't want this in millions, it's way too big. So we're gonna put this in a per share. So make sure you multiply. All right, so next we want to do, so this is the enterprise value. Uh, and that's what it's worth, the entire company. But we want to know, what is the equity value? The equity value is what the shareholders really care about. So to find the equity value, we have to find the total debt. We have to find the total debt, the cash, and the net debt. So, and this is how we're going to find the equity value. So we're going to go equals. All right, total debt. All right, where's total debt found? We already calculated it. 177 million. So let's link it over here. Next, we want to know, well, how much cash do we have? I'm going to go equals. So in other words, just kind of explain it really quick. If the company sells today and you're a shareholder, how much is it? How much is the company worth? How much are you going to get? Well, that's after the debt holders are paid. So what we're going to do is we're going to find out, well, how much debt there is. Well, we're going to find out how much cash there is. And then since the cash is owned by the shareholders, well, we could use that cash to pay off the debt, and that's going to be net debt. So it'll be debt minus cash. So where to find this? I'm going to go to the financial model. I'm going to scroll all the way up to the balance sheet. And on top of the balance sheet, we have a lot of cash in this example, 75.4. And then what we want to do is, well, how much net debt we have. So we have 75.4 million in cash. So we can actually use that cash to pay off the debt. I'm going to subtract out the debt, and that's going to be 101.6. All right, so to find, that's the net debt. So to find out the equity value of the company is going to be equal to the enterprise value, right? That's the entire company, equity plus debt. And then we're going to subtract out the net debt. And then that's going to be the equity portion. And now we can find, well, what is the stock price, the intrinsic value of the company, what we're going to compare it to the actual $26 a share. So I'm going to take those shares, or the equity value, and I'm going to divide it by the shares outstanding and then multiply it times 1,000. So we're valuing the company at 28.7. The market rate for this company is 26. So it might be a good deal. The market rate is below than what we're valuing it. So it's an undervalued company. It might be something we want to invest in. All right, next we want to do, we're almost to the end of this video, is I'm going to show you something pretty cool here. I got two graphs. And what we're going to do here is, if you enter in the WACC, I'm going to show this work here. I got WACC right up there. I scrolled out because I spent a lot of time doing this. I think it's kind of cool. And you want to hit enter. And I'm going to kind of talk about it. You don't have to do any calculations. Look at that. Let me brag just a minute. How cool is the shadow on this graph? Number one. And the look with that box and the shadow and the numbers. So I think it's cool. And what I did was, and this is a pretty cool sensitivity analysis here. I looked at WACC will impact your company dramatically. WACC will impact it. Up here, you could do the change in WACC. All that means, if you change it to, let's say, 1%, that means we're going up 1% and down 1%, which is kind of unrealistic for a company to have that low of a WACC, but you could do that. And based on WACC, look at the valuation. This is price per share. And then that's the WACC. Look at the enterprise and the equity value. Look how the cost, once it goes up, and how the valuation just collapses. So you can see how WACC is very important. Kind of unrealistic to have a WACC that high. It could happen if a company gets very risky. But originally I had it at 0.1. Some reason with Excel, I might have to do 0.001. This looks more realistic, so type in 0.001. When you type that small of a number, even though it's in percentage form, some reason when you say 0.1, it thinks it's 10%, like you made a mistake. So let's kind of examine it real quick. Is we have WACC anywhere from 11.49, and this is more realistic, up to 13.09. And what you can do is, here's the equity value per share. We're right at 28.7. That's what we're valuing it at. And you can see the impact. If we can get that WACC lowered a bit, look how the stock price will rise, the valuation of it. And look at if it goes up too high, look how it goes down. And right here, what this is the change in price versus the current price. So right now we're valuing the company at 28.7. So it's a plus 2.7. That's what that means. As you can see, if we could lower that WACC, look at that. The price will go up by almost $6 per share of value. That if we buy it today, if that can happen, look all the gains that we could get from it. So I'm going to go briefly to the scenario page. And again, we have cost inflation, we have base case, best case, and worst case. We got sales price for the units, and then we have sales growth. So what you can do is you can go back to our assignment, and I have a toggle switch here that, let's say a worst case scenario happens that we did not anticipate this to happen. Cost is going through the roof. Our sales, our price went down, more competition, and our sales growth did not grow that we thought. So we can see the impact of it, that if things go a little south, look what happens to our price per share, and look what happens, how it's below the actual market price. However, if our estimates, here's the best case scenario, look, we can go all the way up to almost $15 plus the valuation above the actual market price today. So this is a great way to see the sensitivity in a realistic calculations here. Okay, so I think that's it. So in the first video, what we did was we calculated WACC. The second video, we used WACC to find out the valuation method of the enterprise value and then the equity value. And then we had a pre-calculated table that showed us how to valuate if we have small changes, how that stock price can change. In the third video, what we're going to do is we're going to look at a table and almost like a sensitivity analysis again, but not as large, but we're going to do the calculations. What if we change our company structure? As in, what if we increase debt, decrease debt? What happens to WACC? How do we maximize the stock price by the capital structure? Because WACC, as we see on that model, if you can minimize it, you can gain some price per share. Equity of the company goes up. So if we could change the capital structure, we want to see what is the maximum price and what is the maximum or the minimum WACC. So I'll see you in the next video. God bless.